As we start to discuss data and data points that should be measured, let's define a few important concepts first so we are using the same terms of measuring the same metrics. First off, let's ask the question, what is a lead? In marketing terms, a lead is any person or entity, such as in a business, that is potentially interested in purchasing your product or service. Some leads are going to be better than others. A hot lead might be more qualified, that is more ready to buy than, say, a cold lead that needs more convincing before pulling the trigger. For this reason, a hot or warm lead would be understandably more valuable to you than a cold lead. But how much more is the important question, which leads us to the second item we need to define and understand, which is, what is the value of a lead? This should be based upon historical numbers. The value of something is what it is worth to you. If you sell windows, let's say at an average price of $5,000 per house and you turn a lead into a sale, then that lead is worth $5,000 to you. However, we know that not every lead you get will end in a sale. In reality, you might only turn 2 out of 10 inquiries into a sale. That would make your conversion rate 20%, right? 2 out of 10. That means you can expect to generate about $10,000 from 10 leads, right? 2 sales out of 10 leads at $5,000 each. That's because we know on average you're closing 2 out of 10 sales. This means that the value of 1 lead is actually $1,000, right? 10 leads, $10,000. Here's the formula as you see here. Lead value equals value of sale, $10,000, divided by number of leads, 10 leads. This example is obviously a bit simplistic, and you can get much deeper with this stuff, and we will. But as we discussed earlier, some leads will be more qualified than others. And we will also want to look at what the actual profit is, not just the revenue. More on that in a minute though. Third thing we need to define is CAC, or customer acquisition cost. Do you know your customer acquisition cost? That is, how much does it cost to acquire a customer? Now we are getting into business costs, which rightfully introduce more numbers. Traditionally, a company had to engage in shotgun-style advertising and find methods to track consumers through the decision-making process, right? Think of marketing mediums like billboards, print, magazine, newspapers, TV, and radio. It is difficult to track the exact ROI for those marketing motions, obviously. However, today in the age of digital transformation, where most of marketing is done digitally, many companies can engage in highly targeted campaigns and track consumers as they progress from interested leads to long-lasting loyal customers. In this environment, the CAC metric is used by both companies and investors. This is how it works. Add up all your marketing expenses, including salaries and overhead, and divide by how many new customers were acquired in a given time period. Now, using our previous example, if you spent $10,000 marketing dollars in a month and added 10 customers, then your customer acquisition cost is $1,000. From here, you'll be able to tell how effective your marketing really is. Now, obviously, there are caveats about using this metric that you should be aware of when applying it. For instance, a company may have made investments on marketing in a new region or early stage SEO that it does not expect to see results from until a later period, right? While these instances are rare, it may cloud the relationship when calculating the CAC. Just take that into consideration. It is suggested that you perform multiple variations to account for situations like that. So the formula is simple. CAC equals dollars spent divided by customers earned. You can take it one step further by identifying your channel customer acquisition cost. Your customer acquisition cost per channel is how much you spent to acquire a customer from Facebook versus, let's say, a trade show, a webinar, paid, organic. The same general formula applies. Now, knowing the CAC for each of your marketing channels is what most marketers want and need to know. If you know which channels have the lowest CAC, you know where to double down on your marketing spend. The more you can allocate your marketing budget into lower CAC channels, the more customers you can obtain for a fixed budget amount. The simple approach is to break out your spreadsheet and gather all your marketing receipts for the year, quarter, or month, however you want to do it, and add up those amounts by channel. For example, how much did you spend on Google AdWords and Facebook advertising? In this case, you might want to put this in a column called PPC or pay-per-click. How much did you spend on SEO and blogging? This might go into a column called inbound marketing costs. Now that you know how much you spent on each channel, you can apply a simplistic formula and assume each channel worked to get the same amount of customers as the next channel. This would be an averaging method. It's not perfect. The only issue is that it can be difficult to know which channel is responsible for which customers. You can easily see where this approach becomes futile. Say you only ran one PPC advertisement on one day, just as a test. You spent $10 and that's all. When you look at your spreadsheet, it will appear PPC would be the best marketing channel because of its extremely low CAC. It would be unwise to double down, obviously, on pay-per-click because you know you really didn't utilize it all for that period of time. For e-commerce companies that sell physical products, it's easy to know what pay-per-click advertisements lead to direct sales because of the conversion tracking the advertising platform provides. In this case, you can determine that value and note this in your spreadsheet. This will give you a better idea of how your PPC campaigns are doing relative to the rest of your marketing spend. Now, I want you to note that this is provided in only some B2B situations like HubSpot or BrightFunnel or Kissmetrics or some third-party software that utilizes APIs. But many other marketing automation platforms fail miserably at attaching top-of-the-funnel marketing efforts with bottom-of-the-funnel customer acquisitions. Not leads, but customer acquisitions and the dollars associated with that customer. It's also worth noting that some tools trace paying customers back to their last touch, first touch, or even multi-touch attribution source. For example, this means you can see the last channel the customer visited before doing their final sales with your business. Now, if a customer came from an organic search result, you would know that SEO would be responsible for that customer acquisition if you're measuring last touch. Now, this is where marketing gets philosophical. Now, one school of thought is that each marketing channel supports the next channel. It's a combined effort. You've heard of integrated marketing communication, or IMC, as you can see in this graphic. For instance, your blog posts reinforce your pay-per-click ads, and all channels work together harmoniously to bring in customers. This is a common notion in outdoor advertising, right? Billboards reinforce TV campaigns, which reinforce radio spots, and so on. Ultimately, it comes down to your own company's philosophy on how to attribute customer acquisition. If you feel that last touch is good enough, you can use that model for your CAC calculations. There are other multi-touch models that split it out evenly that I personally prefer to last touch or first touch, but choose your own calculations that make sense for your marketing efforts. The idea is that you want to get more detailed in your understanding of customer acquisition costs per channel instead of just as a whole. If you know your customer lifetime value, then you can divide your CLV, your customer lifetime value, by your CAC. Now, if you know your customer lifetime value, then you can divide your CLV by your CAC. Now, the ratio of your CLV to cost of customer acquisition is a very important metric as it gives you a sense of your business sustainability. You should be focused on finding ways to increase that ratio by increasing your CLV and or decreasing your CAC. Knowing this will help you know how much you are able to earn per year based upon the number of customers you have and customers you acquire. This will then help outline your yearly business expenses. Point is simple. Know your current metrics, set the targets, then develop the appropriate marketing plan. This answers the all-important question. Ultimately, how much am I comfortable spending to acquire a site visitor, get a demo, a trial, or a lead? This starts to build the foundation of your marketing strategy.